And welcome. You are watching, listening to the Financial Survival Network. I'm Kerry Lutz, and today it is September 13th, 2021. Well, transitory inflation turns out not to be so transitory. And what does that mean to you? And what are you going to do about it? Well, person we're about to speak to has been talking about it for quite some time now, talking about our good friend Michael Pento. You find him at Pento, P-E-N-T-O, Port, P-O-R-T.com. Pento Portfolio Strategies. Michael, welcome back to the show. Great to have you on.
Always great to be with you, Kerry.
So, transitory inflation. I mean, I was looking at a list of commodity prices, and it didn't even include wood. It didn't include aluminum. It did have nat gas, and this was like a week and a half old. The nat gas price had gone up 118%, and it's not like oil. Nat gas prices, yes, they will fluctuate temporarily based upon weather, but we're now seeing nat gas prices 515 per million BTUs. We haven't seen anything near like that since the polar vortex several years ago, and that was truly a transitory weather pattern. Um, to see nat gas just going up on its own, and it's got nothing to do with what's happening in Russia because we're not part of a global market. It's a US based market in natural gas. Is this the tip of the spear, tip of the iceberg?
Well, for me, this reminds me a lot of what happened in the great financial crisis, the leading up to the great financial crisis. The stock market peaked in the summer of 2007, and the oil price didn't peak until the summer of 2008, August of 2008. But you didn't get the signals correct. You didn't understand where we were headed if you just watched oil. You had to understand and have a developed model that looked at the arcane data points that you need to focus on to understand what's happening next. Now, I completely agree with you that inflation, if you measure it the way we did in 1980, is running at 14%, Kerry. 14% inflation. And that's when Mr. Volcker, the chair of the Fed back then in 1981, took the Fed funds rate to 20%. But going back to the Great Recession, I don't think you should focus on oil as your leading indicator of where we're headed next. Inflation is a lagging indicator. And right now we have what I think is, as I said, the worst inflation this nation has ever seen right now. But what's going to happen in 2022? That's the most important thing. We're at the end now, coming to the end, the fourth quarter. We're very close to the fourth quarter of 2021. And you see the expiration of $50,000 per every US family on average was given out by the US Treasury to stay at home and not produce goods and services. $50,000, $6 trillion was helicopter money, MMT, papered over the United States like we've never seen before. That's going from where it was 25% of GDP from 2020 to 2021 to 2% of GDP. That's given even if the Democrats can get through their $3.5 trillion 10-year stimulus package, which looks to me like it's not going to happen. You can't get past, God bless the senator from West Virginia who said, I'm only doing $1.5 trillion. We do not need to give people any more of this money. They need to go out and get a job. There's something like 10 million job openings right now. Let's see if we could stop paying people more money to sit home than they would if they got a job. So here's where I come down on this. I think we look a lot like Japan in 1989. I'll get into that in a second. I think we look a lot like the summer of 2008, where if you're just focused on energy and just focused on the rip-roaring inflation you see right now, you miss the credit crisis and deflation and depression slash recession that's coming up in 2022 because of the biggest fiscal and monetary cliff the United States has ever seen.
All right, so we're approaching the cliff, and basically everybody's whistling past the cemetery. They have no idea what's about to strike. Can you tell us what event you think will precipitate this?
Well, as I just went through, that you are no longer, as a US government, handing out $600 stimulus checks, $1,200 stimulus checks, $1,400 stimulus checks, enhanced unemployment, gig workers getting money, even though they weren't, eligible before, and all these pandemic unemployment programs. You just came off of a mortgage forbearance that's happening all this summer and into the early fall. People have to start paying their rents and mortgages. And all this is happening into the Federal Reserve, which will taper its asset purchase program, $120 billion a month, record QE program, $1.44 trillion at an annual pace. They printed over $4 trillion, Kerry, $4.2 trillion in the last 2 years. The Fed's balance sheet was $700 billion prior to the Great Recession. It's $8.3 trillion, headed to $9-10 trillion before all this madness subsides. Talk about a fiscal and monetary cliff. Next year, according to the Fed's own projections, okay, this is not my assessment. This is what they want to do. Listen to Loretta Mester. Listen to Esther George. Listen to all of the members of the Fed, even now Jerome Powell assents. They are going to stop the QE program because they can no longer, it's untenable to continue to push stock prices this far above underlying GDP. It's untenable to continue to make home prices rise 19% year over year. This didn't even happen in 1980. Paul Volcker is rolling over in his grave. He never would have stood for this. This is amazing. So we're not talking about the Fed raising interest rates. I don't think they're going to get very far. Maybe they get to 1%, but maybe the chaos begins before then. That's my base case scenario.
So
they have to do something. They cannot continue to print $1.44 trillion a year. They just can't do it because they're destroying the country. They're destroying the middle class. They're destroying the very people they purport to want to help. You just mentioned it. Inflation, heating your home, feeding your children, buying a home, making your rent payments that you have to do now. It's just untenable given this massive inflation that the Fed created. Remember, they had a 2% inflation target. Well, they kind of did that and then another turn, maybe even 2 turns. And if you measure it correctly, 7 turns. So of course they're going to stop QE. Stopping QE, no more increase in the money supply, no more increase in the broader base money supply, no more increase in M2. And guess what? The consumer is soaked in debt. They're running up massive amounts of credit card debt. Now tell me, Kerry, why is it that I keep on hearing how the consumers in such great shape, the balance sheet on consumers and corporations have never been better, but they're running up records amount of credit card debt? No, I think we're in for a fiscal and monetary cliff. It's happening now. It's going to become particularly salient in 2022. And then watch out below. You're going to see inflation, like it did in 2008, just fall off a cliff.
And this is going to be worldwide too, isn't it, Michael? It's not just the U.S. China is going through the same thing, and Europe certainly is. The ECB, they're claiming to be tapering, but can they taper and just watch the whole house of cards collapse? Or won't there be a call, do something, anything, print some more money, or raise interest rates and print money, whatever you have to do, just do it, because we don't want to feel the pain, which is what got us in this mess in the first place, right?
Well, listen, this is why I run a portfolio called the Inflation, Deflation, and Economic Cycle Strategy. Yes, you're correct. We're on this roller coaster, this boom bust roller coaster, and you better get the direction correct. I mean, if you're out buying energy stocks now because oil is West Texas crude is $70,
Mhm.
and you hear from Jeff Kerry from Goldman Sachs that it's going to 100 because we might have a cold winter and the supplies are constrained. I think you're completely missing what's gonna happen. You have to get the cycles correct. We are Japan. This reminds me, Kerry, of Japan in 1989.
Yeah.
If you look at I would encourage all of your very erudite listeners, all of your audience, to go put up a chart of the total market cap of equities to GDP. It looks a lot, we look a lot like Japan in 1989. And I'll remind your viewers what happened in Japan in 1989. For the next 20 years following 1989, home prices dropped 45% over the ensuing 2 decades. And the Nikkei Dow lost 85% in 2 decades. Now, tell me, does the Bank of Japan, did they try to do something to stop that from happening? Absolutely. They tried and they tried and they own the entire JGB market, Japanese government bond market, but they're incapable now of all the money printing they've done. They're still 30% below their top in 1989. So I have no doubt, Kerry, that the Federal Reserve and the Treasury will react, but it'll be ex post. It'll be after the great crash occurs. And what will they do, by the way? I
Yeah.
think if you ask me what they'll do, they're already at 0% interest rates. They're already in the middle of QE. Maybe they go back into QE, and maybe even Joe Manchin agrees that we need this massive injection of helicopter money, multiple trillions of dollars. Maybe that's the difference. Maybe that's how we avoid Japan. But let me ask you this, Kerry, is that the prescription for a healthy and viable economy, to stagflate the United States into oblivion? I mean, let me just tell you that. Just listen to this. The total market cap of equities to GDP in 1980 was 40%. Today it's 207%. And if you look at the public debt to GDP, it was 30% in 1980. Today it's 128%. So there just isn't any room we don't have the healthy underlying, foundation that we had, relatively speaking, in 1980. I mean, this is all a big farce. We don't have the firepower to get us immediately out of this tailspin, and we don't have the low levels of debt that allows us to heal. Because the American economy has to lug around almost, if you look at total debt, not just the national debt, public debt, if you look at total debt, so public and private debt, it's almost 400% of GDP. That's a record. So I don't see the wiggle room here to get out of it. And that means we could look like Japan. You don't want to be leveraged long, 10 houses, and margined up the yin yang when this crisis hits in 2020.
Well, we can't pay the debt off. That's obvious. It's unsustainable. It's getting impossible to service it. Are we heading for a debt jubilee here at some point?
So we have a record amount of junk bonds. Let's just look at the high yield debt market, a massive amount of issuance. Well, why do you think that happened, Kerry? Because when the Fed pushes everybody out on the risk curve, and zombie companies can raise debt for virtually nothing, that's what they do. They act in their best interest. Now, here's an example. Throughout, not 1980, throughout the 80s, the average yield on junk bonds was 14%. Today, the average yield is 4%. The spread to treasuries has never been more narrow. There's a record amount of issuance. 20% of all public companies are zombies. So, they can't do much here. There's not much they can do, because if they continue to print money, they're going to stagflate the United States economy into oblivion. And if they stop printing, which is what I think they will do, if they stop the issuance of helicopter money, at least for a truncated period of time, we're going to have a deflationary recession / depression. They did this. It's their problem. That's going to be our problem if you're someone who just says, I want to buy and hold the stock market, we are Japan 1989. We're China 2007, which is still down 40% from that high. Does the people, let me ask you a question. Does the People's Bank of China try to control and dominate their markets? Does Chairman Xi Jinping, does he try to manipulate his market? Yeah, he does. And it's still not successful. It's still a train wreck. So don't tell, this is where I disagree with, listen, I'm an Austrian economist. I agree with you on so many fronts, but there's a lot of people who are out there doing this linear thinking. What is the reason why we have 14% inflation today when they couldn't get to 2% for years upon years? It's because they did what I told them they had to do for years to get inflation. Print a bunch of money. Don't just give it to Wall Street. Give it to people. They stay home. They lay fallow. They don't produce goods and services. And you have a massive amount of record inflation in the United States as we speak. But that's all changing next year. So don't get stuck with linear logic. It doesn't work.
So what's left standing next year, Michael?
Say again, I'm sorry?
What is going to be left standing that you could put your money into? And because we're going to see deflation. If we see destruction of credit, that automatically means deflation, right?
Kerry, you remember 2019? Mm-hmm. This is not a COVID issue. I get very aggravated when people say, well, if it wasn't for COVID, blah, 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 blah. No, the Federal Reserve got to 2.5% in the summer of 2019 on the Fed funds rate. And they had to retreat aggressively 3 times before anybody heard of the Wuhan virus. And the reason for that is we just have too much debt outstanding. We had so much debt outstanding back then, which were the halcyon days of debt compared to where we are today, that you couldn't raise interest rates to 6% like they were in 2000 or 5.25% like they were in 2008. You only got to 2.5%. And the debt we've added since then is astronomical. So you probably will only get to 1% on the Fed funds rate before we blow the whole thing up. And you might not even be able to end QE before we blow the whole thing up. And to answer your question specifically, what works? I have named the 4 things, the only 4 things that I think will work during a credit crisis, which we're headed towards, I think, in 2022. And I think it's going to be the second quarter, if I may be so bold to make a guesstimation of when it's going to happen. It's only 4 things. It's high levels of cash, own the US dollar, short-term US treasuries, and shorting the stock market. The 4 horsemen of the apocalypse. Those are the only 4 things that will work. Mm-hmm. And then on the other end of that, and I don't know when, because I don't invest this way, I look at my model every day, I believe we're going to have a protracted period of vicious stagflation, destruction of the dollar, destruction of the purchasing power of our currency, especially against hard assets. So that's coming in the out years. But what's ahead right now is the fiscal and monetary cliff a la 1989 Japan, 2007 China, 2008 United States.
So are people, though, going to panic when they see everything going down the tubes and jump into precious metals and hard assets?
Well, I think initially that would be a bad move and I think again because of the direction of the dollar. I've been in the business 31 years. I left out gold initially because gold is something that the shadow banking system will sell and sell in earnest, looking for liquidity. So what happens in a liquidity crisis? What do you need? You need dollars. And that's what they'll do. They'll sell everything they can, Bitcoin, gold, silver, every kind of stocks. The correlations go to 1 in a credit crisis. They sell everything. Look what happened in 2000, in the fall of 2008. You wouldn't want to own gold or silver You wouldn't want to own anything other than the four things I mentioned. And even in February of 2020, you wouldn't want to own gold. You wouldn't even want to own long-term, duration U.S. Treasuries. Everything was going to hell in a handbasket, as they say. Because the only thing that works is short-term Treasuries, the dollar, shorts, and cash. Only four things. Four things work. Four. And you have to own those four things. And if you own those four things, you probably won't, not only will you not lose money, you'll probably make money in the next debacle. And it's coming. I mean, Kerry, you're smarter than I am. Look at that. Look at that. Look at that face. Look at that face. And you have your temporal lobe is way bigger than mine. What do you think? What in the world did we fix as a nation? Either interest rates, money printing, reliance on government stipends, the valuation of equities, the issuance of junk bonds. What in the world did this country fix?
Nothing.
In the credit crisis, following the wake of the Great Recession / credit crisis / pandemic. What did we fix?
Nothing. There's no question.
We made everything worse, much worse.
Well, I remember my mother, my grandmother telling me a story that during the Great Depression, if you had $100 bill, you couldn't get change for it. The supermarket didn't have it. And there were actually people who would discount it, give you like $92 or $93 back for your 100, because you couldn't even go to the bank while the banks were closed. Couldn't get change there. Are we going to see a day like that arise again?
Well, you have FDIC insurance. I mean, they'll paper the world over with US dollars in the wake of the next crisis. Again, in the wake of the next crisis. We have a lot of tools already in place for the Fed to buy. I mean, they've proven that the Fed can buy anything. I mean, their charter says they can only, they have a discount window. So a bank can come with their treasuries and get a loan on those treasuries assets at a discount, the discount window. I mean, does the Fed where did they get the authority to buy junk bonds? But they did. They're directly monetizing. They directly monetized $4.2 trillion of treasuries and mortgage-backed securities. Do you think they'll ever shrink that balance sheet? I think we tried that in 2019. It didn't work too well. It didn't work that well. Yeah, we got a lot of problems going forward. The issue is that China, coming out of the Great Recession, China bailed us out in a big way by going through this massive credit boom, and they supported all their commodities, supported the world, helping the world come out of the Great Recession. Can China do that again? I don't think they have the capacity to pull that trick again. So I'm amazed at the idea that people are so quiescent, have so much faith in our Treasury and our Fed to bring us out of a tailspin. It took 5 years for the S&P 500 to get back to the same level it was in 2007, following the Great Recession. 5 years, that's a long time. I mean, I'm 58 years old. I really don't want to wait 5 years after I lost 50% of my assets and my retirement goes down the tubes. But 5 years would be really good, a good outcome the next time. I think in 2031, 10 years from now, we will say that the average annual return on the S&P 500 was zero, zippo, with major drawdowns in term that must be traded correctly.
I hear you, and no surprises here. It's just a question of when it's going to happen and what event they will blame it on. We had our global health issues, which led to the collapse, basically ongoing collapse. It's still going on now, but nobody seems to know because it's being papered over. And you just have to wonder what these guys are thinking. How can they be? It just makes no sense to me, Michael. Like, they keep digging a hole deeper and deeper, and now the hole's starting to fill up with water, and they're too far down to get out of that hole. They're going to drown.
Well, I can guarantee you this, Kerry. The one thing they will never blame is the fact that the government did the wrong thing. And if they do think the government did the wrong thing, it will be that they didn't borrow and print enough money the
That's
first time. That's the sad part. That's the sad part.
the Krugman thesis, you know?
Yeah. If only we were attacked by aliens, we could pretend we had a war. Just print, dig a hole and fill it, and everybody would be happy.
There's one crazy theory on the internet that says that they're going to do a fake attack of aliens on the world, and that's going to bring us to one world government, and that's going to justify all their actions that they have to do. I mean, I'm like skeptical because, you know, it's the internet. I believe everything on the internet. Let me make that clear. Everything that I read, I know is true until I read something else that's more true. But it's kind of funny because that's you look for the scapegoat. You know, one thing that doesn't get talked about enough in China is their like infrastructure is horrible. They got thousands of dams that are all ready to collapse, and the Three Gorges Dam. And imagine while all this is happening, if the Three Gorges Dam goes and knocks out 50-60% of the Chinese economy. I mean, this is you know that it's going to be some culmination of natural disasters and man-made monetary disasters here. You know it's all going to coalesce into one thing here.
Well, Xi Jinping said that, you know, listen, they're going through the egalitarian socialist experiment right over there, and they say, listen, if you're a corporation and you're making money, we're going to expropriate that capital and distribute it. That's where you are in China right now. That doesn't sound like the prescription for rapid growth. China is an immense asset bubble, the worst deformation of capital distribution the planet has ever seen. Oh, by the way, they have falling labor force, negative labor force growth. That's a poop sandwich. So I wouldn't count on China bailing us out. But what I will say is that I could hear Bernie Sanders say, the reason why we have the problem of a depression and deflation in the United States in 2022 is that we didn't pass the reconciliation bill of $3.5 trillion, which he wanted to be $6 trillion. And we didn't expand the child, income tax credit past December, and that was lifting children out of poverty. So what we need to do is pay families to stay home and give this permanent form of welfare. Don't you care about children? Don't you care about them? Well, if you cared about them, you would give them money, right? You would want to encourage welfare, one parent families, and perpetual poverty, like Lyndon Baines Johnson did. The answer is we didn't do enough. That's what's coming in 2023. Probably some permanent form of helicopter money and MMT for everybody who doesn't make $1 million a year.
All right. Well, hey, sometimes the cure is worse than the disease, right?
And when they get 50%, Rome was the world's reserve currency. You had no competition, and their inflation went to 1,000%. So I don't think the U.S. dollar has to lose ground against the euro or the yen to really get crushed against hard assets and lose your purchasing power and standard of living. So just be careful. Be careful. Don't be a stop clock, and don't listen to, CNBS will tell you, buy and hold strategy. No one can time the market. Don't you know that? Well, don't be Japan 89. Don't be China 2007. Don't be the US 2008. That's my advice.
I couldn't agree with you more. And what you think is going to happen is seldom what actually does happen when it unwinds, because you can never really get the full picture as an individual because there's so many forces taking place, so many factors that we can maybe focus in our limited attention span 100 different factors. But, we got hundreds of thousands of factors. But I tend to agree with you. We're going to get major deflation and then bouts of inflation. I think you said this last time we talked. We're going to keep going back and forth between deflation and inflation. Hey, I'm waiting to see my transitory car insurance go down for the first time in my life, Michael. I did see it go down during the pandemic because no one was driving, and everybody said, "Hey, you got to cut the premiums here because nobody's driving. You're not paying any accident." No personal injury cases because nobody's on the road for 3 months or 4 months. So they actually did cut it. But that wasn't really deflation. That was just public outrage. It's going to be interesting to see here. So pentoport.com, go there, check out Michael's work. Really need to talk to him, connect with him on the web because it could save you a lot of grief. And he's not saying to sell your gold quite yet, but just to understand that even precious metals, just like in March 2020, can take a major, major hit. If you got a question for Michael, shoot us an email, kl@kerrylutz.com. Make sure you sign up for our free newsletter at Financial Survival Network. Michael, always a pleasure. Thanks so much.
Always a pleasure to be with you, Kerry.